It's been a month. Did you miss us?
Of course. It's one of my favorite things to do is break things down. And you know what? I kind of like it because it makes me think at a higher level and moves me a little bit further from the day to day to kind of look holistically at what's going on. So it's a great benefit for me as well.
It's like you gotta zoom out to see things in the right perspective. Well, I'm glad that you make this time for all of us because it's very interesting as well to get a breakdown of what's happening in the market. So without taking too much time, do you want to give us just a quick tidbit of what we're going to talk about today, and then maybe we can hop into everything?
Yeah, so we build on everything we talked about really over the last few months, and I at this point I can say years, right? As we broke everything down from the early days of COVID, liquidity, how that's going to cause inflation, how that's going to cause the Fed to put on the brakes. It's just one big saga in this giant experiment. So we're going to break down of where we are today. When is the Fed actually going to pivot, and what is the likely outcome for the economy and financial markets based on what we're seeing?
Well, I'm holding on to my pants as I'm sitting down. I am on the edge. I'm excited. For everybody, this is Itay, CIO of Equi. Itay, do you want to take it? Let's hop into it.
Let's hop right into things. So we are Equi, making elite investing accessible. And I'm going to start today with the market update. Today is March 2nd, 2023. And we'll start as we did last time. A lot of people gave me feedback that they really like this short-term view, short-term sort of trading view. So we'll start there and break this down for you a little bit on a technical level, as we haven't really done so in a while. And we're going to look at about a year and a half of the stock market, S&P 500 here, starting April 2021. So it's really 2 years, and now we are in March of 2023. So we all know a bear market started in the first trading day of 2022. So the top literally as January 2022 started. And what you're seeing here is just a simple chart with the 200-day moving average. So a lot of people use the 200-day moving average to gauge where the trend of the market is. It's very simple concept, really. It just takes the last 200 closing prices and smooths it out into an average, so you can see it on the line. So you can see all throughout 2021, market is trending well above this yellow line, and this yellow line is sloping upward, showing that we're really in an uptrend. Then January has this regime shift moment where market actually breaks below this 200-day, shoots back up, doesn't really exceed 3.5%, comes back down, tries to get up again doesn't exceed 3.5%. And then for a whole year, essentially lives below this 200-day moving average. So the summer 2022 rally really just stops right there and makes it to new lows. November, December of 2022 also stops right there and comes back lower. Things have changed in January of this year. We have broken out through the 200-day moving average. The slope is not as lower as or is not as accelerating downward as it was before. And right now we've traded 6.5% above it and retraced all the way back to it. And as of today, the market actually rebounded from touching it. So this is potentially something we watch for. It's a very psychological level for technical traders, as they are watching to see that what they use this basically as an indication of whether the market's in an up or a downtrend.
Great. That's an awesome insight. Thank you.
Right. Let's talk about volatility regimes as well. So the VIX and the VIX range is really what we talk about here. This is also a chart of this time period, but instead of measuring S&P prices, it really just measures S&P volatility through the VIX. So the VIX basically measures the ratio of options in the market, and are options more expensive or cheaper, and that is an approximation of future volatility. And we can see here in 2021 that we were in this bull market volatility regime with the lows at about 15 and the highs, call it 25 to 30 range. And really, this is a period of stability. And in January, we had a regime shift, really December, January regime shift, where the lows came in the 1920 area and the highs came in the 35 to 40 area, even though some argue the VIX could have been more expensive during this bear market because it was a slow grinding down bear market. Volatility regime really stayed elevated. in January, February, we pierced below that 19-20 area all the way to 17, but then came back to this 20 to 23 area. So again, this is really the big question: is do we stay in this bear market volatility regime and next stop is 35, or does this piercing lower was an indication that we're starting to move back towards 15, back towards a bull market volatility regime? Again, one of these things that we're watching really carefully.
Itay, two super quick questions. What historically does the VIX tend to be at?
20 is the long-term, very, very long-term average. So we're right there.
Right there. And then when you see the high spikes, like the 35s, the almost 40 readings, is this just saying that the price of options, both put and calls, are expensive in the market at that given time? Is this the way to interpret this graph?
That's correct. And typically that happens during periods of heightened market volatility, which makes sense because people really want options during those times because they want to protect for price movements.
So an enduring war is not pushing this VIX any higher than 20. It still keeps it around its historical average.
Yeah, I mean, it's interesting because you actually did get a 35 spike when the war started, but then it faded very, very quickly right afterwards. And then you had all this up and down. But right now, the VIX is just trending around here. It's been quite some time since we had the last spike. The last spike, the 35, was around October. And the market has moved up since, but VIX has gone all the way back to the bear market low end. So again, the big question is, do we grind around here? I mean, I think we're probably going to grind around 20 for some time before the market finds a direction.
Sounds good. Thanks.
Another way to look at it, and don't be confused by all these bright colors, I'll break it down for you fairly easily. What we see here in green is S&P price, so that's pretty easy. What you're seeing in orange is the realized volatility of the stock market. So how much volatility is actually going on in the market at this time. And then the white gives us the implied volatility, or what the options market volatility is. What's interesting is, as you've noticed, you may have noticed this, but when we get very expensive option pricing that can exceed, or at least in a bear market regime, bull market's slightly different, that exceeds the historical volatility, we could have troughs in price here. And when we get the other way around, where options are relatively very cheap to the real movement, you can see tops in the market. What we're seeing now is somewhat interesting. Volatility as measured by realized volatility is fairly low compared to the last year or so. And options are more expensive than what the market is realizing. So it is possible that the VIX is going to go lower unless actual volatility picks up in the very short term.
Cool.
This is my favorite chart in the world.
Is this a chart or is this a Jackson Pollock? What is it?
So, we talk about the S&P 500's volatility. This is the VIX of everything. So you're seeing the VIX of equity, the VIX of bonds, the VIX of the VIX, the VIX of Europe, the VIX of the NASDAQ, SKEW, and the VIX of the Euro.
It's everything. It's everything.
So what's interesting here is that there are really big discrepancies from bonds being priced very, very high. NASDAQ is somewhere in the middle, and Europe and currencies are very, very low. So this is another way to basically see that financial assets are not certain over the outcome, and different markets are actually looking at different potential outcome, different potential volatility. So very interesting time.
Don't ever show me that graph again. That's I have nightmares of trying to interpret what I just saw there.
Yeah, no problem. So one of the things that you keep hearing or have heard over the last few years is, cash is trash, inflation is high, or before, I heard two sides of this argument. You have to invest because inflation is high and you're losing money to inflation. Or when rates were zero, you have to invest because you're not making any money on your money. So you have to put it in different assets, kind of the FOMO effect, or as they used to call it, TINA, there is no alternative. And what you can see here in this chart is the total amount of money that's parked in money market funds. So again, very short-term securities, call it almost treasury securities, that is just sitting in cash and effectively getting a yield. And we do see that this number now is at an all-time high. It's roughly $4.8 trillion sitting in various money market funds.
So if rates get cut, doesn't that just mean this is another wave of inflation about to hit us in something? If all this money is just parked there, just clipping a coupon?
Right. So the question is, what's going to cause this money to actually move over into risk assets? And you can see historically. So here is really the 2001 period where the Fed pivoted here and then cut rates aggressively. And it took some time until money started moving into risk assets because they were really waiting for 2002, 2003, which was the bottom. Similarly, the 09 cycle was very similar. Fed cut rates in 08, but you didn't really see money coming back until 09 or 10. And then during COVID, we had a massive surge of cash. And really it stayed up here and rates are 4.75% and rising. So there's very little incentive for them to move to risk assets right now.
But this is really interesting when I see this, because even during one of the greatest bull market runs of all time, 08 to 2022, it looks like the drawdown was maybe only about 2 trillion of that sideline money. So even though we may be at 10, is it really feasible that like maybe only a portion of that's going to find its way into risk asset? Like it almost looks like part of it is just stays in cash. I don't know for what purpose. But
so I think this is one of the most misleading graphs out there because it's looking at total dollar amount, but it's not looking at holistically as a portion of the portfolio. So think about over the last 20 years, value of bonds, value of equities, value of homes. So as a proportion of total assets, is that cash really high? And the answer is it's actually lower today if you look at it on holistic view of its portion of the portfolio than what it was in 07, 08. So in 07, 08, when rates were very similar, it was almost 10% cash allocation. Now it's somewhere around 2.5% to 3%. So you can actually make the argument that much more cash needs to go into sideline if rates stay as high for this long, which could put a lot of pressure on risk assets. And this is, I think, the other side of the argument people don't really follow.
Super fascinating. So that would mean more money to still come sidelined?
Right, because
that'd be destabilizing then to markets, right? Because that's a liquidity drain.
That's exactly right. So I think this is kind of one of the most interesting parts of this argument. Yes, there's 4.8 trillion, but what proportion is that from total amount of assets? And I really think that point is typically ignored.
Cool. We're getting good stuff, man. You're drawing great conclusions today. I like it.
Yeah, thank you. So, we've been following the Fed balance sheet for years, really. If anybody remembers from the very early calls when we were at the beginning of the pandemic, we were pointing out that this massive surge in liquidity coming from the Fed balance sheet could result in a pretty big spike in risk assets. And, guess what? The correlation to the Fed balance sheet is still incredibly high. This is what we've seen as of February. We know that the Fed balance sheet is continuing to draw down. Risk assets have just continued to follow. And I'll do one even better. What you're seeing in this chart in dark blue is the total amount of reserve parked at the Fed with different banks. So it's an even better proxy of liquidity because you can track this on a weekly basis. And here is the S&P 500 in blue. It's just stunning how even the small fluctuation in total reserve parked at the Fed just matches equity market movements entirely.
Very interesting.
Okay, so question I keep hearing time and time again is, when is the pivot going to happen? And right now, as of early 2023, or at least, yes, I keep finding a way to put that picture every single time.
It happened, but I was just waiting. I wasn't sure when it was going to go down. For people that are just listening to it, this is our obligatory Jay Powell making it rain with Benjamin's picture. So it will find its way into every picture until there's a new Fed chair.
When you talk about the pivot, this has to happen, right?
Yes, it does.
So with inflation has slowed down over these last few reports. In early 2023, there was a lot of speculation that the Fed pivot could come sooner. But as we expected, this view was proven incorrect in February. That's really what we talked about over the last call, as the most recent report, PCE CPI, did show that inflation is stickier than expected. A lot of Fed speakers have come in to really make it clear the Fed is not pivoting anytime soon. And this is how markets looked like about a month and a half ago, where the dot plot, each dot represents a voting member of the FOMC. So this is basically where they're projecting interest rates to be at different periods of time. So the dot plot was at about over 5% on the short-term rates for 23 as of December, and then closer to 4% foreign change for 24, and then eventually coming in to 3% in 25. And you can see the market was completely not believing this, right? So the Fed fund futures here was 75 bips, or in this case, even more dovish than the Fed. Basically, the market saying this pivot is much sooner and much more aggressive. That has changed dramatically as of today, where not only that the market is believing the Fed fund futures are now pricing in more aggressive than what the dot plots even imply, which is interesting.
Is this the first time you've seen them come around to this?
Actually, no. So I did some extensive digging into Fed fund futures projections and the dot plot in different cycles. And what I found is that towards the end of the cycle, the market does tend to overestimate where the Fed is going to stop. So it's kind of funny, because in a way, the fact that the market has stopped pricing the rate cuts make it more probable that we're going to get the rate cuts, because now financial conditions are tightening even further, and the likelihood of recession increases even more because of the tightening. So that makes it more likely that the Fed will pivot and the Fed will actually start cutting. So it just doesn't necessarily mean that this Fed fund future market is right. As we've seen, it's wrong often. But it is interesting that now they're actually overpricing. Like, look here in 2025, the Fed fund futures is still pricing 4.25%. So higher for longer is definitely getting priced in very aggressively.
That makes a ton of sense. Are you going to talk about at some point today, are you going to talk about the inversion between the 2 and the 10?
Yes, that's one of our recession indicators. But so generally speaking, right now, the Fed pivot has been pushed to approximately July. I talked about it in the last weekly insight. We saw Eurodollar futures pricing July as a place where the Fed is going to stop. We also see that in the VIX term structure. So I won't dig too much into that, but the current market expectation is a July pivot. So again, a few months ago, March was supposed to be the pivot, and clearly that's not going to be the case. So it keeps getting pushed out in time. The 60-40 is still not working. These two lines here, we're going back here to 2021. Here's the January 2022 top. Here's where we are now.
Real quick, I know some of us know what 60-40 is. Can you touch again on it and what it is, why it's an important benchmark, and then what you were about to say?
Yeah, of course. So the 60-40 portfolio is this idea of being 60% in equities and 40% in bonds as a much more stable alternative to just being in equities. Just because historically bonds and stocks would, they have an inverse correlation, or at least a neutral correlation.
This is what the wealth management world is all built off of. So this portfolio is likely what a lot of individuals' portfolios look like who are invested with a wealth manager, correct?
That's very true. And what we've seen, because of rising interest rates and high valuations, is that they're both just moving in tandem. In fact, you can still see that it's effectively one trade. So in orange, you see the TLT, which is the 20-year US Treasury benchmark. So it's a good benchmark for bonds. And here you see the S&P 500 in white. And it's very clear that they're still moving very much in tandem.
Got it. And just to interpret some Itay speak here, what we're saying is it was a good wealth management tool in a lower interest rate environment because the bonds actually offset the equities and vice versa. So you had a more smooth way of compounding wealth. But in a rising interest rate world, the bond prices actually fall. So your stocks are getting hit, and then the one thing that you needed to do your defense was the bonds, and they're not there anymore. So anybody that's sitting with a wealth manager, they're probably calling them up a lot, or the wealth manager is having to do some still some just hold on in there, it's going to get better type of conversations.
That's right. And also something to note is that stocks have moved more, they whipsaw a little bit more. Bonds move more in straight lines, right? The ups and downs in the bond market are not as extreme. And then you can see many, many times equities overshoot on the upside and then actually undershoot on the downside, given where bonds and interest rate are. Just another observation off this chart. If you some people that I know trade the spread between these two and have done so very successfully last year.
Sounds good.
All right, let's go into the inflation update. As we all know, every CPI report now seems to be news breaking and gets the market very, very excited given the direction of the Fed. So what is it all about? Initially, the hope for a pivot was this big drop from 9% to 6.4%. However, as you can see in the last report, inflation really started flattening out here. And the big risk, the big worry is, are we staying in that 6% range and flattening out for a while? Because that's going to be what's going to cause the Fed to stay higher for longer. And that's exactly what the market is watching. And if you recall this chart, we warned last report that what we were very worried about, and we continue to be worried about, is the stickiness of services inflation. So here you have the breakdown of the different inflationary components. You have energy in orange, you have food in yellow, you have commodities here in light blue, and then you have services in dark blue, and that's excluding energy. So everything else has come down to some degree. Services continue to rise, and they still continue to rise over the last report.
That's the best question here. Why are services continuing to rise?
Right, because rising input costs from before caused an increase in prices and wages. Wages and service price are just incredibly sticky. It's pretty unusual to start, getting salary reductions and things like that, especially since the labor market is still very tight and very competitive. So that is a big problem for the Fed. The Fed actually does want to see higher unemployment because of this reason. So higher unemployment will probably result in lower services inflation, but we're just not seeing that yet.
Now, honest question to you. Every time I go and I buy a coffee or a tea, and they turn around that POS system at me, and it defaults to 20-25% tip. Is that factored into this service, what's it called, inflation or not? I'm just curious.
Money paid. So some of these tips are not even reported. You have to go to the BLS to find the right answers there, even though they don't necessarily get all the right statistics there.
I think that service inflation should be even higher, or is that my food cost there? What do they classify?
I think that's considered food cost. Yeah, services, you're talking more about like getting your haircut or wages and things like that.
Okay, just had that a little fun there.
Yeah, no problem. Let's dive into the economic update. Now that we covered inflation, the market is trading the hopium again. So this is kind of funny because the narrative has changed so initially everybody's like, well, we're going to have a soft landing, which means we're not really going to get a recession. Everything's going to work out. Inflation's going to slow down. We're going to have a mild recession, or we're just going to have flatline growth. Now they're just talking about a no landing at all. So they're saying, well, the labor market's so strong. If inflation cools off, maybe we won't have a recession at all, and we'll still keep economic growth out there. So you can see the no landing story just keeps rising, and soft landing is no longer in fashion, right? So now the no landing is in fashion, and I think that's highly, highly unlikely. So many things have to go right for that to happen. So first off, M2 money supply growth is in total collapse. It's net negative now for the second year. And obviously we know M2 exploded after the pandemic. It was 40% or so increase. This is, year over year, you're almost at 26%. But you see that what's really, really interesting is that nominal GDP growth tends to follow that M2 money supply growth with an 18-month lag. If you plot those two charts, that's been the case since the 1960s and even before that. So with this total collapse in M2 and the total amount of money supply, if this relationship still proves to be correct, it's very likely we're going to go into negative GDP mode, which is, the definition of a recession.
Got it. And the definition of recession is negative GDP for 2 quarters in a row, which we've actually already hit. Correct? Correct.
Well, we hit one, and then there was an adjustment, so there was actually a move up. So technically, we're not in a recession yet as far as the GDP definition of it, but we're very likely to be there either at the end of this year or early next year.
Got it.
What's interesting, you look at some of these leading indicators. Cost of equity is definitely rising. So there's an implied cost of capital, implied cost of equity in financial markets. And you can see that, right now we have a pretty aggressive increase in cost of equity. That's price to earnings ratio. So this tends to happen just around a recession. So we got
this blue graph. Is this the interest rate for debt for public market companies? So
it's not necessarily debt. It's the cost of their equity per se, which could come from different outlets. But the main takeaway here is that odds of recession just increase as the cost of equity increases as well.
Okay. Got
it. What you're seeing too is that we have this large disconnect between the quote soft and hard data. So soft data tends to be leading data. So surveys, the classic example is like at the architecture bill. So billing for architecture firm tends to get billed before things actually get built, right? Because you need the architect to work on that. So the architecture billing survey is going to be a leading indicator for housing starts, right? That's an example. So when you see the soft indicators moving lower, it typically leads to hard indicators. So now we have soft indicators moving lower and haven't been moving lower really for the entirety of 2022, but hard data has not moved lower as nearly as much yet. So just something else to consider. When you're looking at all these leading economic indicators here in red, and now again, you can look at the global trade volume in blue, or total US industrial production, you see that they follow this leading indicator quite well. And they're still pointing substantially lower over the next few months. So again, another indication of a potential recession coming in. I think this is one of the more powerful indicators out there because housing tends to be one of the more volatile and yet leading parts of the economy. But think of all the things that have to do with buying a new home and all the consumption that has to take place when that happens. So we've already seen a 20% drop in residential fixed investment, and now it's below trend of the total amount of households in the United States. Again, pretty important yellow flag for a recession as well. What you notice here is that we were not in a housing bubble the way we were in 2005, 2006, because when your residential investments increase much more over the number of households, that's a very classic bubble right there. Here you did have an increase, but it was nowhere near the magnitude of the 05-06 housing bubble.
When we put this residential fixed investment, is this just like dollar figure of what's going into residential housing? What is this?
Yeah, it's basically dollars going into investment for creating, new housing and things of that nature.
Okay.
So again, it's not pending home sales. We've seen pending home sales collapse. We talked about that on the last call. Here it's the total investment, and that's actually falling quite a bit as well, which is ironic because eventually will cause to a housing shortage, right? But that's potentially a few years away.
Okay.
So here again, ISM's another one of these indicators. They've actually never been this slow without a recession. So just
ISM. What's an ISM?
It's basically a survey of U.S. production manufacturing.
Okay, so it's saying that we're just not producing as much.
I mean, new orders are lower and demand is lower, leading us here to the 2x10 yield curve.
Okay, 2x10. So there's our inversion right there. We are
2x10 yield curve.
100 bips now.
Almost 100 bips, 90 bips or so, 89 bips. We went, I think, to 90 some intraday, but we didn't quite get to 100. Most inverted since late 70s, early 1980s. This was the only time that things got more inverted. But remember that the nominal rates were in the teens, right? The 2-year treasury and the Fed fund rates got into the teens in the early 1980s. So mathematically, it's going to be more difficult to get this level of inversion today. And again, these very, very, very substantial inversions almost always have a recession following. So the shaded area is a recession.
Yeah.
And you can see the recession here after this period of inversion.
It would almost be interesting to see that inversion figure over like whatever the prevailing 2-year is, because if it's 100 bips over 5 basis points on the 2-year right now, it's a pretty healthy amount. But if it was in the teens, it's not, that inversion isn't the same like magnitude on a percentage basis.
That is correct, which is why I take this period with a grain of salt. So in a way, this is as extreme as it gets.
Very interesting.
So typically when the recession starts, the steepening occurs as well, because there's a few ways in which this can disinvert. One way would be if the longer dated treasuries, like the 10-year, will start rising in yields. That's called the bear steepening, but it could also happen if the Fed cuts rates on the short end and then the 2-year yield falls, which is more of the bull steepening. So either variation of the two is probably going to happen. Either the Fed stays higher for longer, sending yield on the 10 higher, or a recession forces them to cut rates.
Why would the yield on a 10 go higher? Is it because the short runs higher, or is it because people sell off of the 10 and go to the 2?
If the belief is that inflation stays sticky for a long period of time and we're in for a long era of high interest rates, then the 10 should at least reflect some of that, right? Because right now, 4%, if we are going to be in a 4 or 5% environment on short-term treasuries for a long time, those 10s are potentially underpriced. That's more of the stagflationary scenario. Okay, let's talk real quick about the earnings of corporate America, as those tend to be pretty important for future direction as well. Revision of sentiment has been fairly negative as well. Just again, in these all these conference calls, asked about what do you believe future is going to look like, forward guidance, things of that nature. We see that trend in Europe too, not just in the United States. So even though earnings growth is still decent, and we have seen earnings growth being okay, we are seeing that the year over year is falling quite a bit. And earnings surprise is now quite low. I'll just put it out there. Wall Street analysts tend to be very bullish. There's typically a buy rating for most stocks. They just have this bullish tilt to them of buying stock. So having positive surprise often is not unexpected. Post-COVID, we had very strong positive surprise, maybe because the guidance was too low by analysts, but now we're getting in a situation where there's just very, very few positive surprises out there. So we're well below trend for positive surprise. So this is a data set you have to look at with a positive bias. So that's, again, another yellow flag. What I think is one of the biggest yellow flags, or almost a red flag, is how many CEOs and CFOs during earnings calls have mentioned weak demand for their company and their products and services. You can see that count is now higher than what it was in 08, 09.
Very interesting.
So again, this is a chart I saw. It's kind of interesting as well. You can see the stock market has followed the consensus earnings per share for the S&P 500 for the entirety of the bear market. So there's been revisions. So what is common here is that stocks discounted the earnings season the last month of every quarter. So this was December, right? This is September, and this is June. So the big question is, does that happen again in March or not? Because currently EPS is substantially lower than what market pricing is. Okay. This was, quite a good digging into the economy, earnings, markets, etc. The one thing that is still incredibly strong is the labor market. It just baffles people continuously with every jobs number. Are all these things happening, and the job market just continues to be so tight? So now I'm not looking at the actual unemployment number. I'm looking at initial unemployment claims as a leading indicator for the employment market, right? Because first you file a claim for unemployment if you lost your job, right? And only then you're considered to be unemployed. We're still incredibly low in this indicator. We're not seeing any surges of claims just yet.
But what I don't understand is, because we spend a lot of time in tech. It's always very clear that it's not always very clear. It's been clear as of recent that a number of firms are actually downsizing. So who are the people that continue to be adding that are making up for the cuts that are happening in this segment?
Yeah, just remember that the tech economy is such a small fraction of the actual economy or the larger economy. However, they could be counted. It's just a couple of percentage points, I think even less than that. So you have to keep in mind that the majority of these jobs are more of blue collar type jobs out there, or even more of the white collar type of services economy that's not necessarily tech. However, tech could be seen as a canary in the coal mine. Like we have seen that a few times in the past. So this is definitely something to be watching for. The Fed is looking for the unemployment numbers to start hitting a little negative. I think once we get our first negative NFP like jobs numbers for 1 or 2 months, then we're probably very close to the Fed pivot. That would be my opinion. So if you want to time and figure out when the Fed pivot's going to be, watching the labor market's really important. And it's really important too because the consumer is not in great shape, right? The consumer, for the most part, is living paycheck to paycheck. So the labor market and the health of the labor market is really important for the consumer economy and for the recession, because you can see the saving rate here in green. That's COVID, right? So we all know we have that giant spike. Economy's shut down. Nobody can spend any money besides online, and they get all these stimulus checks and they get all this unemployment benefits. That's the second stimulus check, by the way, right here. And then on the other side, you see credit card debt. So credit card debt back to all-time highs, saving rate below pre-pandemic levels. Consumer is not in great shape if there were to be a recession. Is
it also safe to say that this credit card debt may continue to rise because as debt is out there, that's high yielding debt, and you're paying more APR on a higher amount?
Yeah. And last month we talked about how credit card interest rates have made new highs recently. So that's definitely a part of that. So again, I'll leave you with that. What do you think it is going to be? A soft landing, a no landing, or a hard landing, right? It's the key question for 2023 because it's going to have wildly different outcomes for financial assets. And
Itay, I'm going to ask you too, is, knowing what you know about the greater macro economy, how is that impacting how you're currently designing your portfolios for this foreseeable future?
Yeah, so a key part of that is making sure that we're staying well diversified across different types of managers and portfolios that can do well in all these type of conditions. That's very important, first off. But then second of all, we've seen the correlations pick up in 2022, and we know that historically correlations pick up during bear markets like 08, 09. I don't necessarily believe in that argument that just because we had a down year, that means we're not going to have another down year. There's been multiple occurrences of 2 or even 3 down years in a row. So given the volatility of macro deterioration in earnings and the fact the Fed pivot is nowhere near right now, I think that staying fairly defensive, but at the same time taking advantage of unique opportunities that exist in this market is mainly what we're doing. At the end of the day, it remains a trader's market, not necessarily an investing market quite yet.
Good to know. All right, well, everybody, thank you so much. This has been a great time, and yes, Itay, we'll see everybody in a month with some more updated graphs and fun and some humor.
Sounds good. See you next month.